Most traders believe they lose because of bad entries. They think the problem is time, but entries are rarely the real issue. The real problem is how traders think about the market, what they focus on, and how often they feel the need to act. The market doesn't reward activity, it rewards patience, structure, and understanding. In this video, we're going to break down how professionals approach trading, from psychology to macro conditions to on-chain behavior, and why doing less often leads to better results. Now, let's get into trading reality checks. Here's a reality most traders don't want to hear. You don't lose money because you're wrong. You lose money because you trade too much. Sideways markets are where accounts slowly bleed, not because price is unpredictable, but because traders feel uncomfortable waiting. Boredom becomes the trigger, and boredom creates forced setups. Professionals don't look for action, they look for clarity. If the market isn't clear, they don't trade, because capital preserved is future opportunity. Doing nothing is not hesitation, it's discipline. Let's move on to the psychology before execution. Before any trade is placed, a professional checks one thing first: their state of mind. Are you calm? Are you trying to make money back? Are you trading because you feel like you should? Revenge trading doesn't feel emotional in the moment. It feels logical. That's what makes it dangerous. Emotion disguises itself as confidence, and confidence without clarity leads to mistakes. The best traders step away when emotions rise, not because they're afraid, but because they understand timing applies to mindset too. When clarity disappears, execution should stop. Now to the on-chain and macro context. Price doesn't move first. Liquidity does. Before major moves, professionals watch positioning, funding rates, open interest, and where risk is being absorbed. Macro conditions matter more than most traders admit. Interest rates, inflation data, global risk sentiment. Forex traders have always understood this. Crypto traders are still catching up. Macro doesn't give you entries, it gives you context, and context shapes bias. When liquidity shifts, price eventually follows. Now, to protocols, tokens, and real utility. Not every token exists to go up forever. Some tokens are infrastructure, some are incentives, some are simply noise. Utility doesn't mean price pumps tomorrow. It means demand survives market cycles. Ask yourself one question: what actually breaks if this protocol disappears? If nothing changes, price action won't save it. Speculation is loud, infrastructure is quiet, and quiet systems tend to last longer. Let's look into how professionals see the chart. Retail traders see candles, professionals see behavior. Support and resistance aren't magic lines, they're memory. They represent where traders entered, where they panicked, and where they got trapped. Charts are human psychology made visible. Price revisits emotion more often than it respects indicators. Understanding that changes how you trade. Finally, let's talk about real world impact and final thoughts. Crypto isn't just charts and speculation, it's faster settlement, open access, programmable value. Speculation dominates attention, but infrastructure quietly reshapes systems. The traders who last aren't chasing every move, they're building understanding. They trade less, they think deeper, and they let the market come to them. Because in the long run, clarity compounds faster than activity.